What is going on, guys? Nick here, back with another video and back to YouTube. I honestly did not think that this was going to be the first type of video that I made as I come back after I took about a month and a half off. But honestly, I just feel like I've been thinking about this so much, I really just had to say it on camera. I had to tell you guys. So I think most of us probably recognize by now the market has been down by a lot over the past couple of weeks, couple of months, really most of this year. And I think what is kind of bothering me is how many people are really down and feel completely discouraged about investing in the stock market because of this. The reality is, when you say you want to buy high and sell low, what a lot of people really feel best doing is when they sell low and they buy high. Unfortunately, because the market is so down, all of these people think that, investing's over, their account's ruined, they've lost all their money. For some of you, that actually might be the case. I'll go into in a little bit why that might be and how you would know if you were one of those people. But for a lot of you that have been doing your due diligence and making sure that you're getting good prices for what you're buying, that really shouldn't be the case. And if you are feeling bad, it's telling you that you're not very confident in the long-term belief of the company, or you're just not quite as sure. So as a long-term value investor, you shouldn't be so concerned about technicals. Technicals don't really matter for how the stock price is going to do long-term. Yes, there can be times where the stock price is down for long periods of time. You can look at 2000, 2003 coming out of the tech bubble. You can look at most of the 1970s. But the thing is when the market is down like this, these are the absolute best times to buy. Nobody looks back at March 20th and thinks, oh my god, what a terrible time to invest in the stock market, right? That's when the stock market was at its bottom, basically, after COVID first hit. Everybody looks at all the purchases at that time and thinks like, oh my god, I can't believe this traded for that price. And I'm sure in a couple of years that we're going to look back at the prices that we're seeing today, and we're probably going to think that. Honestly, there's a couple stocks that I've been just looking through on my watch list, and it's honestly surprising just how cheap some of these have gotten. And of course, for me, I haven't changed any of my strategy from my last video that I made. I'm still doing my theta farm, and that's basically generating me all the income that I'm actually using to invest. So basically, I'm using stock that I own to generate income, and then I'm reinvesting all of that money myself. So like I said earlier, some of you guys might be actually in trouble because the stock market has fallen. So I'm going to show you guys what to kind of look for to figure out if that's your position, if you should reconsider your stuff, or if you're in good shape and you just need to be patient and wait it out. A lot of long-term value investing is really just about being patient and waiting for the market to move on its own. So for me, seeing this, YouTube actually tells me what you guys subscribe to. So I subscribe to all of those just to understand what it is that you guys like to look at. What are other people talking about? And look at all these really sad face thumbnails. It makes me sad. It doesn't make me sad because the thumbnails are sad. It makes me sad because all of these people are telling you, the market just tanked. Real talk. I think this is actually about something else, about Meet Kevin. I think he was talking about whatever happened to him a couple months ago. This is the recession. I don't know. Unemployment's at 4%? I don't think this is a recession yet. The red pain continues. Guys, the red pain is the best time to buy. If this feels painful to you, I don't know what you're doing, to be honest. You should feel best about buying right now. Look, nobody likes to see their account go down. I get that. But recognize you can get some pretty incredible deals out there if you go look for them. So, one of the stocks, though, that I've heard some people talk about is Shopify. So, let's pull up Shopify really quick. Shopify is down a lot. Alright, so looking at Shopify looks like in November of 2021, it peaked at almost $1,700 a share, and it's now down to $428 a share. That's a pretty big drop. So, I wanted to kind of figure out what's going on. Is this like an incredible deal? Was this a crazy bubble? What happened? So what I did was I went and I pulled up their latest annual report. And let's go look at, this is a quick way to find the income statement. Just search for the balance sheet. Usually they're right next to each other, and the balance sheet is typically mentioned a whole lot less. I've noticed that. Okay, here we go. So, taking a look at this, it looks like you had a slight increase in subscription solutions. It looks like they increased by 1.2 billion on merchant solutions. It looks like cost of subscriptions didn't really go up that much. Merchant solutions went up by about 700 million, I guess. So gross profit did increase by, a pretty considerable amount here. That's really not bad at all. Operating expenses, I don't really see any, dramatic changes that stick out to me. It looks fairly similar to kind of what we're seeing with gross profit. All of that is good. What we notice, though, is when we look at the net income, though, there is a massive difference here, right? So they go from 319 million to 2.9 billion, right? That's a crazy jump. And if we were just looking at Yahoo Finance, let me just show you guys something. So it looks like the PE ratio is only 18, right? And on a company that's growing this fast, that's gone from, basically increased by $1 billion. I don't know what the rate of return or rate of growth is on that, but that is a massive jump. So a PE of 18 would seem incredibly cheap. However, this is such a large jump, you should be a little suspect when you see that, especially when you don't see that with the income from operations. So what you notice if you look down here, out of this block right here, what sticks out is this right here. 2.8 billion for net unrealized gain on equity and other instruments, right? And if we look, it says note 6 right here. It explains exactly what this is, right? So that's very unusual, and that's not part of the business, right? They didn't make this in profits. They didn't get it from, their subscriptions and their merchant solutions. They got this from some other deal that took place, and it added 2.8 to their profit by the end of the year, right? So let's go find note 6. As described in note 6, in November 2021, the company received an investment in a private company, Flow Commerce Inc., as non-cash revenue consideration. So basically, all of this profit comes from a single merger that I guess that they did with Flow Commerce Inc. So this isn't part of the business. And if you're taking this into account as a part of their income statement, you're kind of misleading yourself. So while this company might seem really cheap now that it's, it's dipped to a PE of only 18, is it really that cheap? Let's kind of figure out, right? So if we basically take their net income, so 2,914, right, and subtract this 2,859, that means they actually only really profited 55 million for the year. That's not great, right? And then on top of it, if we just look at their income from operations, so they actually only made 268 million from their business operations. Going over to their current market cap, it's about 54 billion. So that means right now for 54 billion, that means you're currently paying 201 times operating income for the stock right now. 201. That is a lot. We go over to the PE calculator. PE reverser, right? And I know obviously operating income is a little different. 201. Yeah, 201. So this would be a growth rate of like 37%. Look, that's a lot. But the reality is there's a lot better deals out there on the market right now than paying this premium right now for Shopify. If you bought at the the 1,600 price, I'm sorry, but you absolutely overpaid, and you should be sweating right now if you own a whole bunch of Shopify stock. However, now if we look at my my PE calculator, of course it's not loading all the way right now. But if we go and we start looking at some of like the really high quality large cap tech companies that have continued to grow at very high rates for long periods of time, and that we don't really see any big threats to their business, for example, like Amazon right now. So Amazon, I know, is going to report earnings in a couple of weeks, and we can see if we just look at the past couple of quarters for Amazon. Now keep in mind that this isn't just one quarter being reported, this is actually the trailing 12 months. In the last quarter, if you just take the last 4 quarters, add them together, they earned $64 per share. That is pretty steady, solid growth. This is the type of thing that you want to see when you're looking for good, solid, long-term investments, right? Well, we can see when we look over at the PE ratio, let's just zoom in a little bit so that we can see it. So we have seen pretty steady growth with the earnings per share over time, but we can see that there's been a pretty big dip in the share price up at the top. Look at this PE ratio for this company. It has traded around, 100, 200. It's right now at a low of 45. I'm going to pull it up on Morningstar just so you guys can kind of see the long-term growth. But I know that Amazon is obviously under a lot of pressure because of inflation, because of increasing labor costs, because of increasing fuel costs, and these certainly will hurt its margins. But long term, it's going to impact everybody the same, and Amazon still has the best moat. It's still the place that people still go to search for stuff on the internet, to order stuff directly to their house. None of that is changing. So for me, this is one of my favorite things to look at on Morningstar. It's the key ratios. So when you look down at the growth for Amazon, you can see this 10-year average right here, and that's obviously going to give you a really steady, smooth, and consistent number. And then the other thing that I like to look at is just go up this line right here and see how consistent it is. And we can see that Amazon has really consistently grown somewhere between 20 to basically 25% year over year. And then when we look down at their net income growth, we can see that this is actually an even more accelerated number, although Amazon increased their profits quite a bit lately. Most of that's because of AWS. However, right now you're still paying about the cheapest price that you could have ever paid for Amazon at only a PE of 45. And when I go over to my PE calculator and find out what that comes out to as a growth rate, that would be a growth rate of 19%. 19% growth is a very good deal for Amazon, especially when it's really been growing around 25% per year for quite a long time, and I again don't really see that changing. Right now my valuation is very high for them, $5,500. You know, obviously these are just because a valuation says something, that doesn't mean that the price is actually going to be there. This is just what the underlying fundamentals says that the company should be worth. One of the other ones that really sticks out to me right here is Facebook, or Meta. It's trading at an implied growth rate of only 2.8%. Let's take a look really quick at what that comes out to. Yeah, so the PE ratio is right now 13 PE ratio on Meta. And now I know a lot of people are freaking out because, oh my god, they lost subscribers for the first time. Realize that Meta is an advertising platform first and foremost. They went from 1.95 billion daily active users or monthly active users to 1.95. So you're telling me that you are getting rid of them because they only have 1.93 billion people to advertise to? That just doesn't really seem to follow any logic to me. Looking over at the key ratios, let's throw this in a chart just so we can see how this looks. I like charts. Yeah, so here's Meta's chart. This is again a company that's trading at a PE of 13 right now. It basically only has to grow 2% a year to make this valuation make sense. And this looks like pretty significant growth to me. Certainly not 2% per year. Looking over at Morningstar's key ratios, checking out the growth. I mean, look at this average growth for them. 37% revenue growth, 28%. I mean, I think you actually have to be crazy to think that they can't grow more than 2% going forward. I certainly think that if you talk to anybody who does any type of online advertising, that they'll all tell you that Facebook is absolutely one of the best returns on investment for online advertising, obviously along with Google as well. And certainly Apple and Google or Android cutting down on the amount of data they have access to for their ad tracking is going to make things a little harder for advertisers to get their return on investment back out. However, it's still so much better than advertising on the radio, advertising on TV, putting newsletters up in random places. I mean, where else are you really going to go to get the same access to information and audience that Facebook has? I just don't really see an alternative for it. So even if their user base were to drop from 1.95 billion users to 1.93 billion users, I mean, who cares? It's still a massive, massive platform with an extremely powerful advertising arm. You know, this is an insane number to me. I actually did up my investment. I told you guys before that I'm doing automatic investments where I put in like $1 or $2 a day. So this one I did up on Meta. So every day I continue to buy more and more shares of this company. So if it falls, great, I'm going to get more shares for even cheaper. So it just brings my cost down. I'm really, again, not concerned about the price going down. It's gone down in the past. The stock market's gone down in the past. Guess what? It's always going to go up in the long term. Long term, I don't care really what happens to the market over the next couple of years. I don't need any of this cash over the next couple of years. So if I can get better prices and the market's going to stay down for the next year or two, so be it. That's a better deal for me. It's going to work out better for me long term. It's going to work out better for you long term. So if you're feeling a lot of pain, if you're scared about the market, if you wake up every day and you look at your account and you just think, oh my God, why did I invest all this money? Unless you need the money right now, don't freak out. there's no reason to freak out. You're getting better prices. Nobody looks at big downfalls in the stock market prices as bad things in the future, because guess why? The price comes back up. You're going to feel a lot better. Now, people do tend to look at times like we experienced last year where the prices shot up a whole bunch. I'm sure people in the 2000s tech bubble felt the same thing, where they look back in hindsight and think, God, that was a dumb time to buy stock. But at the time, it felt like, you couldn't miss. Everything was going up 1,000% every single week. That's kind of the same situation we're at here. Again, don't forget the golden rule: buy low, sell high, not buy high and sell low. So don't worry about this market dip. Everything is going to be okay. And as always, thanks for watching.